Australia is set to dramatically hike capital gains tax rates after the ruling Labor Party made an agreement with the Greens to pass the contentious taxation legislation. So let's dig into it, and if you've got thoughts about it, well, you can let me know that in the comments below. Now, the short of this is that the Labor government was having difficulty passing the legislation, so in order to get it passed through the Senate, they needed to form an agreement with the Greens. The Greens, as part of this agreement, forced the Labor government to make a bad law even worse, by undermining the ability of self-managed super funds to invest in property. Now, the problem with all of this is it's ultimately going to make us all poorer. It's one of those situations that by raising capital gains tax rates, they're going to undermine economic growth, undermine transactions in the economy by creating a worse lock-in effect, and then ultimately grind the economy ever slower. And this ultimately, over the long term, is going to reduce the amount of tax the government ends up raising, thereby making the government poorer, making the individual poorer relative to the status quo ex ante, and creating the equivalent of a deadweight loss. It's a situation where hiking capital gains tax rates does not raise more revenue and undermines overall welfare. We can already see some of this manifest in what's happening in New South Wales. With the New South Wales budget, they're forecasting, it appears, a reduction in stamp duty revenue from property transactions. And this arises because with higher capital gains tax rates, people hold onto their properties for longer, so you get fewer transactions. This undermines stamp duty collection because that stamp duty would be collected on transactions. So you can easily see here a second-order effect from the government's decision to hike CGT rates overall. You get more of a lock-in effect for assets. And just one example of what is going to go on throughout the economy. And you can see the implication. The government is not going to raise as much revenue as they anticipated, so they're ultimately going to try to raise rates in other areas to make up for their stupid decision right now. Now, of course, if you are looking to try to navigate some of this uncertainty and the policy schmozzle that is going on, well, I'll include a link in the description below to my fund. We've had some good performance recently, so you might want to check that out, especially if you're interested in a fund that is not going to buy into the government's BS and actively is going to fight for our investors' rights and for their financial future. I'll include a link to that in the description below, and if you say that I sent you, well, of course, I'll waive the management fees for the first year, so you get a bit of a deal if you happen to be interested in checking that out. We're only open to sophisticated or wholesale investors, but still, if you're interested, reach out to us. So with that in mind, let's dig into some of the policy details, see what the Greens have forced Labor to do to get this through the Senate, and dig into why there are so many problems with what Labor is trying to do. And a lot of this is grounded in some modelling that I did that I'll link to in the description below. It goes through all of the problems with what Labor is trying to do, particularly their ignorance of the second-order effects of hiking capital gains tax rates. Okay, so let's look at what Labor's plan was. Historically, before this plan, the way capital gains were taxed was they were taxed at your marginal tax rate, but if you held an asset for longer than 12 months, it would be taxed at half your marginal tax rate. For many people on property sales, that would be about 23.5%, because in that year where you get a large gain from that property sale, it would often force people into the top marginal tax rate, meaning ultimately they'd face a 47% rate, which then gets cut to 23% or 23.5% if they've held it for more than a year. Now, of course, the Greens like to say that the long-term capital gains tax discount benefited high-income earners. But in reality, they were high-income earners for that 1 year when they sold the asset. They weren't necessarily high-income earners for the other years. But that is a slightly separate issue. Labor, of course, decided, oh, we want to try to raise more revenue. I emphasize try because they're not going to raise more revenue. We want to try to raise more revenue by hiking CGT rates and then coming up with this sham idea that you need to hike capital gains taxes in order to bring them in alignment with income taxes. So what they're going to do is going to tax capital gains at the person's marginal tax rate. They're going to remove the long-term capital gains tax discount. Now, they are notionally only going to tax real capital gains, but there's a lot of nuance to that, meaning that the losses you might have occurred, those aren't going to be indexed to inflation, which means your ultimate tax rate on real gains could well exceed 50% on a diversified portfolio, such as a portfolio investing in startups, for example. So Labor's plan was to try to increase capital gains taxes. Labor was also going to impose a minimum capital gains tax rate of 30%, meaning that even if you were a low-income earner, for example, you didn't really have much income otherwise, but you happened to sell something or another in a given year, you would still be hit with a 30% tax rate on those earnings. That, of course, is a problem because it raises rates for lower-income earners. The Greens, of course, thought that the policy did not go far enough, so what the Greens wanted to do is effectively stop super funds from investing in property, because everyone could see then what you would do is instead of investing personally, you would go and invest in things in super funds because they would now face a much lower tax rate relative to investing outside of super funds. So the Greens decided, okay, we're going to stop people using the super fund to buy property. The way they would stop this is by stopping one of the conventional mechanisms through which people would borrow to buy property in a super fund, effectively stopping people from borrowing within a super fund. Now, there's been some discussion about whether there's workarounds for this, but nevertheless, that's what the Greens wanted to do. Now, the net result is to hike the CGT rate at the headline level. Like I've said, 47% tax on real gains. You don't get credit, inflation-adjusted credit that is, for the losses you've incurred. There's a minimum capital gains tax rate of 30%. There's now a minimum tax rate of 30% on any trust distributions. Furthermore, the Greens are now going to stop super funds from borrowing to buy property. Now, this of course would hike the CGT rate. Now, someone who is myopic or naive is going to say, oh yeah, that's going to raise more revenue. The problem is that person can't see the implications of what this tax is going to do. It creates a whole lot of behavioral cascades. For example, you're going to get less investment in startups, and I know the government has said, oh, we're going to try to exempt investments in startups, but that's complete BS. A, we know exactly what the world government is going to try to do. We know this because they told us. So they might create a short-term exemption they then try to reverse. So you'd have to be a special type of stupid to think that the Labour government is going to actually keep that discount on startup investment in place. It's obvious they're going to try to backflip on this. And if you believe them, well then I have a bridge I want to sell you. Because they lied to us to get elected the first time, they lied to us to get elected the second time, why on earth would anyone believe anything they say? Nevertheless, some people will go along with this, which astounds me. Anyway, they're trying to create some exemptions for investments in some startups. The problem is that would not apply to what are called secondaries. So secondaries often apply where a venture capital fund needs to on-sell their investment to another venture capital fund. Furthermore, they don't apply if the company is above a particular size threshold. Furthermore, they don't apply in various circumstances for the later stage investments, meaning that those companies that need to keep raising capital, well, they're going to be fresh out of luck under the government's new policy. For example, if a company needs to do a pre-IPO round, which is incredibly common, and a pre-IPO round can be 2 years or more before an IPO, well, that is not going to fit within the exemptions the government is talking about, meaning their exemptions are a sham. They're basically a facade, a charade, to try to convince people they are listening, but in fact they are not doing so. Notably, as an aside, and I know this is a tangent, but notably as an aside, there's a Treasury inquiry into what is going on here. That inquiry has submissions open until the 10th of July. You know what's happening? They're trying to pass their laws before the inquiry. That tells you they're not even listening. They do not care. They're just trying to ram through the tax hike, even though there are going to be some negative on-flowing consequences. Now, back onto the issue here. If we look at the growth impact, I already talked about what would happen with startup investing, but also the secondary market is vitally important. For example, no one is going to invest in the primary market if they think the secondary market is going to be trash. So the secondary market sets the price that then influences the primary market. It's why we need a vibrant, listed equity market. This is axiomatic in the finance literature, i.e. that secondary market feeds into the primary market. For example, a strong stock price enables a listed company to do a secondary or seasoned equity offering rather, and this effectively enables more growth in the economy. The government seems to be incredibly ignorant toward this. So just having investments in the very first initial investment being exempted from the rules doesn't really solve the issue. Nevertheless, that's what the government is going to try to say. Now you're going to get a reduction in growth in the economy, and with that reduction in growth, you're going to get less tax revenue. As something like I've indicated, I have directly modeled. Furthermore, the higher capital gains tax rates are going to create what's called a lock-in effect, whereby people now faced with an even higher rate are going to require the return on the new asset to be even higher for them to be willing to sell the present asset and then to move into that new asset. Now, by exacerbating that lock-in effect, you get a couple of impacts. Firstly, you get no stamp duty or a reduction in stamp duty as the New South Wales government is finding out. Secondly, you get a reduction in growth because instead of money going to its best home where it will generate more growth, people will just keep the money in the low growth asset because it will take them years to make up the tax impost if they were to sell their high growth asset, thereby undermining the growth effect of investing. Effectively, the government seems to have no clue about how investment works. They have no clue about the role investment has with driving growth within the economy. In so doing, by deterring investment, the government ultimately undermines growth and undermines revenue. In my own modelling, the government's 47% tax rate is entirely unsupported by the fundamentals. It is entirely unsupported after you factor in the growth effect of investment, the fiscal spillovers from investment, so the ability of investment to enable a company to go out and hire people, which generates payroll tax, it generates corporate income tax when that person sells things. There's fiscal spillovers from the investment. When you incorporate that, you incorporate the growth effect. When you reflect on the lock-in effects, when you reflect on these other second-order effects, there is no way on earth you can get a tax rate anywhere near what the government is proposing at 47% of real gains. Rather, the capital gains tax rate that should exist is close towards zero. And indeed, it could be less than zero when you believe, as I happen to do in some cases, that the government is inefficient or inept in spending our money. So if you think the money that the government raises is just going to be spent corruptly, for example, funneled into the CFMEU and organized crime, then in fact, money would be better kept in private hands. Because in that case, when the money goes to the government, they're actually just frittering it away. And if they're giving it to organized crime, they're actively making things worse with the money they raise. So it's not just the case of the government being inefficient, it's the case of the government having negative implications from some of this spending. So when you also factor that in, well, the rate could even be lower still. So you put all of this together, and the optimal capital gains tax rate that I find is close towards zero. But the government has been profoundly ignorant of the tax literature. Because while my modeling utilizes a rather novel and new mechanism to get to that result, there were some models all the way back in the 1980s by Chumley and Judd that showed that the optimal capital gains tax rate is 0%. They utilize a different technique to get there, but we reach the same end by discrepant means. The big problem is the government seemingly is willfully ignorant about the implications of their tax rate hike. It is ultimately going to make us all poorer, effectively creating a deadweight loss. The government will, over the long term, raise less revenue, and we're seeing some of this play out with the state governments right now. But not only that, investors are poorer relative to the status quo ex ante. Everyone ends up being worse off. And I will, like I've said, include a link in the description below to my modeling. Now, of course, you can let me know your thoughts about this schmozzle in the comments below. I think it is a terrible situation. I think the Greens have made a bad law worse. But at least the Greens were always honest. The Greens didn't lie to us when they were running for election. The Greens always wanted to do this. Labour lied to us. They lied to us to get elected in 2025. Then they said that circumstances changed, thereby necessitating this change in policy. But if you have a look at what circumstances changed, they didn't, because they were doing a CGT inquiry in early 2026. I know because I appeared at it. And with that CGT inquiry, well, what had changed within 6 months of them being elected? Nothing. It's insane to me that they're gaslighting us about circumstances changing. I'm astounded that people actually buy the BS that Anthony Albanese and Lion Jim Chalmers are peddling. It astounds me that people are willing to let them get away with having lied to get elected and then believe their lies about the lies they told. I mean, some people are just, I swear, I don't know how these people function if they're unable to distinguish between what is a blatant, flat-out lie, documented lie, and what is going on. Still, you can let me know your thoughts about it in the comments below. And if you're interested in investing in a fund that sticks up for you, because I have appeared at the Senate inquiry into this. I've made submissions in relation to the Senate inquiries into this. I appeared at the Wilson Asset Management Investor Day to talk about this. If you happen to be interested in investing in a fund that is going to stand up for you and for your investments, well, I'll include a link in the description below to my fund. I'll waive management fees for the first year if you happen to let me know that, well, you've been sent by me, and otherwise, hopefully, I'll see you for future videos as well.